When it comes to personal finance, it can be incredibly confusing where you get started. And for a lot of us, including myself, I was not taught anything when it came in regards to personal finance in school, which is very detrimental. I wanted to go in here. I wanted to welcome you guys to the live stream. If you guys do have questions or anything, definitely pop them into chat. We'll cover them. There's a few that I want to cover in today's live stream. And overall, starting with the basics, just looking at budgeting. Now, again, if this is really the fundamental for pretty much everyone when it comes to personal finance, budgeting is honestly the foundation. It is how much money is coming in, where exactly is it going, what are you spending the money on? Again, very basic fundamentals. Budgeting is not perfect. A lot of people don't like budgeting. They say it takes an incredible amount of time, but when it comes to figuring out exactly how much you're earning, where your money is going, and what exactly you have left over, that bucket is really what is the most important. So when you start earning more income, you have to make sure that essentially your expenses don't rise faster than your income. In that case, you're living far outside of your means, which can be just absolutely detrimental when it comes to being able to budget and being able to budget properly. And also with that third bucket, it's not how much money you make, it's how much of your income you keep. Now, again, referring to Dave Ramsey, like I often do, it is about your income, and it is the most powerful wealth creation tool you have. If I'm getting an income and I'm only spending, let's say 30, 50, 70% of that on all of my expenses, it gives me a big chunk of income left that I can use for savings, that I can do emergency fund, that I can go ahead and invest. There are a ton of things that you can do with what you have over. Now, when we get into the budgeting methods, there's a couple different ones, and I want to know in the comments exactly which one you are using. First one is the 50-30-20. Now, this is most common, but this really does make a big dependent on where you live. So 50-30-20, 50% goes into your needs. Now, when we talk about the needs, you're looking at housing, you're looking at insurance, you're looking at transportation. When you start kind of breaking it down mathematically, about 18 to 25% of that 50% usually is housing. Another big chunk of that does come into transportation. So that is going to be your vehicle. And then, of course, adding on the insurance. When you start looking at a budget and you start looking at housing costs, $1,200, $1,500, then you buckle into an average car payment of roughly $650 to $700. You put in renter's insurance or owner's insurance, homeowner's insurance, and then you couple on the insurance costs that you're paying for transportation. The 50% does go by pretty quick. Now, 30% is the wants. So this is the category that you're going to have and not really have a lot of requirements around it or restrictions around it. This is going to be going out to eat, shopping, traveling, anything that is going to kind of be the variable expenses that you see. They are going to fall into this 30% category. And then, of course, the final category is the 20%. This is going towards savings, investing, and, of course, the debt repayment. Now, for a lot of Americans that are living paycheck to paycheck, which is roughly 60% of Americans in that same bucket, a lot of it comes down to not budgeting properly. So when you look at the budget, the 50-30-20 rule, 50, 55, even 60% might fall into that want category. You have another 30, 35, 40% following into that needs category, meaning that the savings, the investing, and the debt repayment do not exist at all in their entirety, which is kind of crazy to think. But of course, when you're starting to live outside of your means, then you start supplementing it with credit card debt, which can be very detrimental. Second budgeting method is the zero-based budgeting. Now, this is exactly what I do because with this method, it gives me the flexibility to get to zero every single paycheck and every single month on the budget. Now, what this does is I take my income, I budget into categories until I'm at zero. So that might mean putting a little bit more money into my HSA, putting more money into my investment accounts. That is how I get to zero. In this budgeting method, every single dollar has a purpose, even if it is savings, if it is investing, if it is going towards debt, if it is setting aside more money, let's say for a planned vacation or something like that, you have to make sure, again, zero-based budgeting, you are getting to zero. Another way that we look at the budgeting is paying yourself first. This is something where it is kind of a reverse budgeting. So what you do in this method is you pay yourself first, meaning that little 20% at the end is actually your biggest priority, meaning that paying yourself first, you're putting money into savings, you're putting money into the repayment of debt, you're putting money into investment accounts. then you're living on whatever is left. So essentially, again, you put 20% in first. That is going to be upfront, leaving the rest, that other 80% of that income left. With that 80%, you budget effectively to make sure that that is all you have. That 80% is all the dollars that you have allocated to everything else the entire month. So 50, 30, 20, of course, it's going to be kind of doing it backwards. From there, you can spend whatever is left because, of course, once the needs are covered, then you can get into the wants. Once the wants are covered, you've already paid that 20% upfront. Now, another one that we see rising a lot in popularity is the envelope system. Now, this, of course, is conjunction with really any type of budgeting, but this is doing it on a cash basis. Now, for a majority of people, cash has a different feel. Even using a debit card in relationship to using a credit card has an absolute different feel. When they do surveys, when they do studies, a lot of time and effort goes into this. It has been proven that people that pay with debit cards versus credit cards pay about 16% less in spending. So what happens is if you're using your credit card and you're using that credit card for all of your purchases, you are going to over purchase things by about 16% because psychologically you're not associating it with actual money. That is in an account somewhere. You're not actually associating it with cash. You are taking that, swiping the card, and there's not the emotional tie or even the physical tie to money because with a credit card, you have a credit line. You can go up to the max of that credit line, where with a debit card, if you're swiping that debit card, you can only go up to the money you have in your bank account, and that is it. That is at the point where it stops. Now, of course, with the envelope method, if you are using cash itself, when an envelope is empty, you are done spending in that category. It is a very, very hard stop when it comes to the cash envelope system. And this is the point where you have to take accountability. For a majority of the budgeting systems, a lot of them work. A lot of them, you have to find one that really does work for you. And when it comes to budgeting, again, it is accountability. If you're going to make a budget, take the time and effort to do it. Make sure you do it properly. Make sure you can do everything to really stay with this. And of course, to help out with that, I would download You Need a Budget. There's a Credit Karma, a lot of budgeting apps out there. The Every Dollar app, which is from Ramsey Solutions. There's a lot of different ways. If you don't want to do the old school pen and paper, which a lot of people do, you can download budgeting apps to help you track the expenses. I know even Rocket Money, a couple other ones will actually link to your bank accounts. So you can literally have everything in one place, which is a really, really cool way to do it. Second one we get into is debt. Now, of course, when it comes to debt, it is really just so incredibly prevalent when it comes to the government, when it comes to just the overall spending. It is roughly, I believe the new numbers are about $7,500 to $8,000 per individual in the United States that carry debt. Credit card debt, we know, came in at $1.13 trillion in credit card debt. Even when you think of the average interest rate being around 22%, if you're talking well over $1 trillion at 22%, it is insane. They're saying the average consumer carries about $100,000 in debt per person. And we got a question coming in here. Are credit card reward system a scam or with it? So we'll go ahead and pop that. Is it worth it? When it comes to credit card reward systems, it is worth it in a very small, in a very niche kind of scenario. The only way, and literally the only way that credit card reward systems are worth it is if you are never paying interest. That is the big thing. If you are paying interest, and if you are paying any interest at all with the credit card reward systems, you are buying your rewards. You are literally paying for your rewards. And of course, when you look at Capital One, when you look at Delta Sky Miles, when you look at all of those, they might give you an upfront benefit or a reward sign-up bonus, anything of that nature. The credit card reward systems are there to make money. And when we're looking at $1.13 trillion in credit card debt, that's exactly what it is. When you look at the amount of money, and there's actually a study, I know a couple people covered this study. There's a study from the federal government that said credit cards are a tool to transfer wealth from the uneducated, poor individuals in America to people who pay off their credit card rewards in full every single month. It's interesting to read a study like that, to know that they almost put it on the guidelines of predatory lending, because you have these people carrying over $1 trillion in credit card debt. You have another small group of individuals, which I believe is about 25 to 28%, that pay it off in their entirety. But credit card companies are making an incredible amount of money. And again, if you're not paying it off in full, I personally have a credit card. I pay it off every single time that I get paid. So I will make charges every 2 weeks. When I get paid, that card is paid off in full every 2 weeks. I don't wait for the bill. I don't wait for the end of the month. I don't wait for anything. And me personally, with my budget, with the way that I manage everything, zero-based budgeting, I know exactly what I'm spending to the penny every single month that it is coming out. So even when I pay that with my credit, with my debit card, paying that essentially with my bank account, paying off the bill, I do get reward points, which again, some people don't like them. Even systematically, how the people that can't afford to pay it off are the ones that are essentially just funding these rewards programs to the people who are charging more money. So is it worth it? Again, very niche scenario if you are using them. If you're not paying them off, 100% absolutely not. Credit card companies are getting, a dollar or probably pennies on the dime for getting those credit card reward programs and all of the, perks that they offer that are through a bunch of different places. Is it worth it? If you're paying it off, yes. If you're not paying it off, absolutely not. So getting back into the debt, we have really two forms of debt, which of course are revolving and non-revolving. Now, revolving debt is of course the continuous borrow and pay. This is what you get with credit cards. This is what you get with home equities. It is a big credit line that is a revolving debt. Now, with the revolving debt, there comes a interest cost with it, which is the reason why this is a very easy way to get and really supplement your income. That's what people are doing with home equities. That's what people are doing with credit cards, is they are supplementing their income with revolving debt, meaning that they've kind of gotten in the debt cycle where I don't make enough money in a monthly basis to cover all my expenses. So I use credit cards to supplement my debt, which means that debt is going to accumulate because the majority of people, like we just talked about, our credit card rewards, they don't pay off the debt in their entirety. So not only are they paying for the rewards, but they are also paying interest on those cards. Now, of course, the non-revolving debt, or what they kind of coin as good debt versus bad debt, the non-revolving debt is lump sum paid over a certain amount of time. This is going to be mortgages. This is going to be student loans. This is going to be your secured loans, personal loans, car loans, anything that is fixed rate, fixed term. Even when it comes to some home equities that are exactly that, fixed rate, fixed term, you don't have access to borrow more than you originally borrowed. Now, also with debt, you can look at secured debt and unsecured debt. Now, this is going to be a big difference when it comes to interest rate. Secured debt, meaning there is collateral or asset that is going to be secured. So essentially, you think of a mortgage. If you don't pay your mortgage, the bank is taking your house. Same with a car. If you don't pay your car payment, the bank is taking your car. Unsecured debt is really nothing that is collateralized. Again, credit cards, looking at personal loans. This is just kind of a promise to pay. So if you do not pay for a loan, if you do not pay your credit card bill, there is nothing that I can take. There is no asset tied to this. I cannot go and seize anything, which is the same. Student loans, credit cards are unsecured debt, meaning the only thing that I can do is legally come after you for the balances that remain on there if you're not paying that. Now, of course, when you break down your debt, you have to understand a couple things. What is the total balance that you owe? For a lot of people, this is a question that I ask when I do financial counseling. How much do you owe in credit card debt? Most people will be around $10,000, $20,000, $30,000. What is your interest rate that you owe on those cards? I don't know. What is the minimum payment? I don't know. I usually pay XYZ. I pay $100 here. I put $200 on my American Express. I put $500 here. They don't know the minimum payment. And of course, the big one, they don't know how long it's going to take to pay this debt off. When I talk about a lot of debt and when I talk to a lot of individuals about managing their debt, when the conversation comes up with how are you paying this back, it is just deer in the headlights. I've said this before. Nobody has a plan to repay what they're borrowing, which is kind of crazy. And if you do have a plan, you are probably 10x in front of the game on getting and eliminating that debt and getting to the point of actually reaching debt freedom. Now, of course, there are two big methods that we really recognize. One is the debt snowball. So the debt snowball actually goes in and lists it from your lowest balance to your highest balance. Every single penny is going to go to that lowest balance, and you are going to snowball the payments. So essentially, let's say, for instance, you have 5 credit cards. You have the lowest balance on top, the highest balance on the bottom. You are going to make the minimum payments on 4 of the 5 cards, with the lowest balance being paid off first. As soon as that lowest balance card is paid off, it snowballs to the next one, so on and so forth, until you get to the one with the highest balance, and you're paying that down as quick as possible. Now, mathematically, this one doesn't make and is not the best advantage, but the snowball method is the psychological method of seeing the elimination of debt, where if you have 5 debts, you're doing the debt snowball. Now you have 4, the snowball starts rolling faster. Now you have 3. You will find ways to find and actually pay a lot of extra things on here, and putting a lot more money towards your debt. It's almost contagious. When you start eliminating debt, you will find yourself finding different ways, saving money here and there. Even if it's a couple dollars here and there, putting extra money towards that is going to make a big difference in the long run. Now, the other way that we do this is the debt avalanche. Now, this is the method that I personally use. When we eliminated all of our debt, we just have our home left, which we're paying it off at an astronomical rate. We've been here 10 years. We've already cut around 24 years off. So it'll be done staying on the same path within the next couple of years. And this is going from the highest interest rate to the lowest interest rate. So instead of focusing on the balances, we're looking at the interest rates. Now, of course, with the interest rates, this is going to give you the most bang for your buck. What I mean by that is when you're going in the debt avalanche, that highest interest rate is going to get every extra penny that you have, and you're going to eliminate that regardless of the balance, because for every dollar you're putting in there, and let's say your rate is 25%, every dollar you're putting in there, you are saving that 25% that you're essentially cutting off the top, especially if you can do things. Now, debt avalanche can have a huge benefit with balance transfers. Be very cautious with them, but also with debt consolidation, where if I have, again, 5 debts, let's say the average of those debts are 22, 24%. If I can roll everything back into 9, 10, 11% and just focus down one payment, it is going to make it a lot faster. It is also going to allow it to go a lot cheaper. But the caveat with this is you cannot, and it will absolutely devastate the debt avalanche and the debt snowball method, is if you accumulate new debt. That's it. If you are adding on new debt while you're trying to pay off debt, you will find now that you're paying 2 debts or multiple debts or 3 to 5 debts, it doesn't work if you accumulate new debt, which is the reason why we cover budgeting first, because you have to make sure that you do have that paid off. The third one we look at is the net worth. This is another one. This is the most important one when it comes to your financial picture and knowing what you own, what you owe, what are your assets, what are your liabilities. It is really adding up everything you have. And this should be probably something you're doing every, I would say, 6 to 12 months, honestly, breaking it down. So when you look at your bank accounts, when you look at, your assets, when you look at investments, when you look at the value of your home, this is something that you should kind of have a general idea on a regular basis exactly where you are. And then, of course, subtracting out your debts or, the negative side. It's okay for a lot of people, especially younger generation. If you have student loan debt, for a majority of them, if they don't own a home and they have student loan debt, the calculation is going to come out negative. Don't get discouraged from this. It is going to be a negative net worth, and it is because a majority of the younger generation are carrying the bulk of student loans. But of course, if you're looking at this every 6 to 12 months, so if you're accumulating some assets, you got a good job coming out of college, you're earning more money, you're starting to put money into the 401k, you're starting to put money into investment accounts, you're putting it into IRAs. And then as you're paying down and paying off those student loans, your assets are going up through your investments, your liabilities are going down with your payments. It is really a win-win scenario when you start getting there further. Crack and Crunch, hey, where can I learn about investing from someone new? Like, who can I trust to show me how to read and understand? Like, who do I trust? Personally, I work in the financial industry. I've worked in the financial industry for a long time. Depends exactly how much you're looking to read and understand. Because what I've done is I've always worked with financial advisors. So me personally, I worked at a banking institution. I had one or two financial advisors that I really did trust. Currently, I manage a credit union. I do the same. I have a financial advisor in my office that I work with that I trust. Um, it's hard. And honestly, when you look at a financial advisor, not only the track record that they have, Kraken, is getting to know their personality. Honestly, the best way we did this with Charles Schwab. We did it with a couple different institutions outside of where I work. Is sit down with somebody, do a consultation, and ask them questions. You're going to treat this as a very cut and dry interview process, especially when you look for, the investment side. Everybody is looking for somebody and everyone is looking to make money. Now, that is where there has to be really a fine line of people you can learn from, people you can trust, versus a lot of individuals that are out there that are just trying to make money off you. When you look at some of the fees, when you look at some of the organizations, there's a lot of people, and I really do trust the financial advisors at credit unions because we only partner with a pretty unique set of individuals. But if you're going into a bank, I don't know exactly who you're working with, who you can talk to. But again, it also questions what are you looking to learn? Because a lot of financial advisors will kind of guide you on a path, but they won't teach you how to do it. Like if you're talking day trading, if you're talking understanding, if you're talking kind of investing 101, they might not go into that much depth about it because again, that's kind of their job and that's what they're going to be getting paid for. For me personally, there's a lot of people online. If you go to YouTube, even looking, and again, look for people who are not paid. I know Professor G is out there. Big shout out to his channel. I forget the name right off the top of my head, but he is a professor that I've been following for a while. There's a lot of people out there, and we can kind of talk offline, Kraken, about that. But yeah, it's hard because honestly, when it comes to a financial advisor, you're paying them for a service. So how do you trust them? That again is kind of getting the feel for the character of the individual. That's why I say when you go in there, it is kind of an interview process when you're talking to an individual to really build a rapport, see what they offer you, see what's kind of on the same guideline and what you're looking for. Does it line up to what they're offering and kind of the plan they're coming up with? And again, I don't know if that's exactly what you're looking for, but how to like read and understand what you're looking at. It honestly takes time. Dave Ramsey says, don't invest in stuff you don't know and understand. So that's my biggest concern. Honestly, for that, put in the research. So I will give you a perfect example, Kraken, is when I started investing in cryptocurrencies, I did not know cryptocurrency. And honestly, I take almost like the Alex Hormozi approach to it. I literally spent probably about 2 or 3 months studying, understanding cryptocurrency, learning exactly how Bitcoin works. How does Ethereum work? What is the blockchain? I mean, doing a lot of research, and literally I have notebooks. I'm still old school where I write a lot of things down. I have pages and pages and pages and pages when it comes to really studying and understanding to understand exactly what it is. Same with investing. When I look at ETFs, when I look at stocks and bonds, when I look at things like that, it's really putting in the time to understand exactly what it is. So if you're interested in individual stocks, how do you read them? I mean, even Google searches, you can go through some articles. Literally, I put in probably hundreds of hours before I even put my first penny into cryptocurrency because I didn't understand how it worked. And I wanted to have the ability to actually be able to explain it to other people when they had questions about things like that. And I definitely follow Dave Ramsey. If you don't know cryptocurrency, don't invest in it. If you don't know penny stocks, don't invest in it. Anything that is high risk, don't take someone's word for it without doing your own research. You have to make sure you know exactly what you're getting into, which for a lot of people, if they don't want to put in that time and effort of understanding what it is, that is the reason why financial advisors earn their 1%. Going through, interviewing people, helping to really understand what it is, it's going to take time. And again, if you don't want to put in the time, there's an easy way to do it. Just hire someone to do it for you. Cryptocurrencies, still kind of on the fence with a lot of it, but I do understand it. So a few more things we wanted to talk about when it comes to the financial literacy, which of course the next one is credit. This is a huge one where people really underestimate credit and they underestimate their credit report. So credit is referred to borrowing money. So if you're looking to borrow money, now of course, this is going to be reliant on your credit score. Now there are scenarios out there that people will borrow you money without having a credit score. A lot of institutions won't, but some places will. Now on your credit report, this is going to give you a full list of your debit accounts, how much you owe, who you owe it to, if the payments have been made, when the account was open, when the account was closed, if it's in collections, if you filed for bankruptcy. There's a ton of things. When I pull individuals' credit reports, which I look at almost on a daily basis at work, it tells you a story. You can see the installment loans, you can see the credit card balances, you can see the utilization, you can see the mortgage balances, you can see the revolving debt. There are so many things that you can see when it comes to a credit report. Really breaking it down. Now you can go to annualcreditreport.com and get your report for free. It is a government website. You can actually get the entire report for free, but with that, it doesn't give you a score. But the reason for pulling your credit report is making sure that everything on there is accurate. That is the biggest determining factor. If you go on there and you see things on there that one, are not accurate, or two, that are not yours, you have the ability to actually dispute them through the bureau themselves. That way you can make sure that everything on that credit report is accurate. Now, of course, once you have all the accuracies cleaned up and everything is good to go, then you get a score. Majority of places, when you look at Discover, when you look at financial institutions, when you look at credit unions, most places will give you a score. They have so many different scoring models, but as long as you can kind of generally track where your credit score is, if you need to borrow money, which again, I don't advise, unless you're looking to take on more debt. And I know, again, Dave Ramsey style, taking on debt is super expensive when you're taking on, especially if it is unsecured debt, if it's credit card debt. But scores go from a very poor rating, which is 300 to 579, to an excellent rating, which is 800 to 850. And you have the fair, good, and very good kind of in between there. For a majority of Americans, we see them really in that good category to very good category, depending on payment history. Now, of course, the credit scores are very important because outside of lending, a lot of people use credit scores for a ton of things. Now, this includes if you want to get a mortgage, of course, credit score. If you want to get an apartment, that is right. If you want to have a rental unit, they'll pull your credit score. If you're going to get an apartment, it is a credit score. If you're looking to get a new job, a majority of employers do pull credit because credit is linked to a lot of different things, including absenteeism at work. It is job abandonment. There's theft at work. Bad credit scores in comparison to good credit scores tell a story that you might not hear from an individual. That is why, especially working in a financial institution, credit scores work incredibly well. And those that don't have credit kind of bring a big question mark. Now, again, when you look at your credit, make sure that one thing that is very important is you're freezing your credit report. Now, I see a lot of credit reports that are open, that are exposed, that, people are pulling the credit report. And if there's problems on there, if there's loans that are not on there, somebody else has access to the Social Security number. If you look in big picture, we are seeing identity theft on a regular basis, and it seems like it's rising a lot, which can be really deterred right off the bat if you freeze your credit report. So essentially, when you freeze your credit report, it will freeze all three bureaus. When you freeze all three of your credit bureaus, what this is going to do, if somebody tries to pull your credit, it'll say the credit report is frozen. That's it. That is the end. It is game over. If you want to pull your credit, they give you a 1-800 number. You call the number, you provide the 6-digit code that they mailed to you. When you put in that 6-digit code, it will unlock your credit report for 24 hours. After that 24 hours, it will go back to being frozen, and that's it. It is right back to being frozen at that point, which is exactly where you want it to be, especially if you're someone like me that hasn't used their credit in a multitude of years. I'm not getting new credit. I'm not taking out auto loans. I'm not doing anything with it. So I know that me personally, all of my stuff is frozen. It is all locked up. There's nothing I'm using it for. And overall, I know that it's safe. When we get into the financial education, number 5, we look at the savings. Now, this, of course, is one of the big surprises when it comes to personal finance and when it comes to education. More than 39% of Americans cannot afford a $400 emergency, and we start seeing that rise. When it comes to savings, when it comes to the emergency fund, and I cannot pass a video without talking about the emergency fund, because this is probably one of the absolute biggest detrimental things that I see. Is what happens is you have credit card debt. You continue putting all of your money towards that credit card debt. Let's say your minimum payment's $50. You're putting $300 on there. You're doing great. You're knocking out that debt. You're paying down the credit card debt. Emergency happens. Swipe. You go right back to using that card. Now, all of the money that you have essentially put on that card is gone in one fell swoop because you don't have an emergency fund. I know people that are relying on credit cards as their emergency fund when they're paying it down. The correct way to do this, in the way that I've been taught through financial counseling, is having that emergency fund. And if you follow Dave Ramsey like myself, having at least $1,000. Now, that $1,000 is baby step one when it comes to Dave Ramsey, but that $1,000 serves as your emergency fund. I know it's not a fully funded 3 to 6 months of an emergency fund, but it is the basics to cover the very foundational fundamentals, where if a car breaks down, hopefully it's not going to be over 1,000. But if your tire blows out, if there's an emergency, hopefully that $1,000 is going to cover a majority of it. And most of the individuals that I've seen and that I do counseling with, that $1,000 has covered the essentials, the basics, the emergency fund to have those unforeseen expenses. Once you have that $1,000 set aside, then it is time to debt avalanche or debt snowball, all of your debt gone. Once it's gone, then we're moving to that 3 to 6 months of a fully funded emergency fund, really depending on where you work. So this is kind of the caveat. When a lot of people say the emergency fund should be 3 to 6 months, how do I know? Because there's a big variance between 3 months, let's say, is 15,000, 6 months is 30,000. How much do I know exactly what I need? Now, again, for this, I really rely on where do you work? What industry are you in? Is it sales orientated? Could there be a lot of variance? Is it a very highly proficient skilled job? Depending what you do, this is really something that is going to be unique to you, with being the minimum 3 months. Now, for here locally, if you work at a financial institution, firefighter, police, if you're working for the big three, a lot of job security comes with those. So 3 to 4 months of an emergency fund, great. If you're on the flip side, where used car salesman, a lot of things like that, where again, you can have kind of variations with a lot of your income. Then COVID happens. All of a sudden, dealerships and lots are shut down. All of these people are not going to work. All of these people that were very reliant on those sales and service positions, when you think of cooks, when you think of waitresses, when you think of, restaurants, restaurant managers, restaurant owners, all of them went to shut down with COVID. And unfortunately, if you didn't have that emergency fund to keep you afloat, at least for several months, you would be really dead in the water right off of the bat as soon as it happened, which is the reason why an emergency fund is so important. And the final one we're going to look at tonight is the investing. Now, of course, when it comes to investing, this is probably one of the biggest topics that I get a lot of feedback about. It's because, people are saving a multitude of money. And I actually had an individual that came in that said, I have money. I don't understand how to invest. I don't know how to physically get the money from point A to point B to where I can invest. And then once the money is at point B, I don't know exactly what to invest in. Now, again, if you've watched my channel for a while, personally, I only invest in ETFs. I do not own any individual stocks in any means. Even looking at, I opened a Robinhood account, which we're going to be covering shortly, but looking at a couple different things, I buy ETFs only. And I know, again, Dave Ramsey style, he only buys mutual funds. Mutual funds are just managed where ETFs are not really managed as much as the mutual funds. But of course, with mutual funds, you do get a pretty big percentage that you're going to end up paying someone to manage those mutual funds, where the ETFs, I really hedge the expenses. Even looking at the VOO, which is the Vanguard S&P 500, putting money in there, the expense ratio is a 0.04. So it is next to nothing when it comes to investing in that. And you're really looking and mitigating all of your risk because within that ETF itself, you are investing in the top 500 companies within the S&P 500, which are the largest companies in the United States. Now, there's a couple ways that you can do this, because when you look at like the VUG, which is the Vanguard Growth Fund, it actually buys into 208 companies that are slated or really recommended for growth. But then you can also look at a couple ones that will cover everything within, the S&P 500, like the VOO. But you can even go larger, where you're going the total market, which I believe is around 3,200 companies you can invest in. You can even go in there and do a world one, which I believe was like 34,000 different stocks that you can buy depending on the ETFs. Is an ETF like a high yield savings account? It is separate. So the ETF is actually, the ETF is investing in a group of funds. So it is different, because an ETF is not liquid. It is actually invested. So what it does is it takes a bunch of different companies, kind of groups them together, and that is what you're investing in, versus going out and investing in NVIDIA and investing in Apple and investing in Meta. You're investing in however they built out that ETF. And when you look at some historic growth of the ETF, like again, that VOO, and even Warren Buffett says everyone should invest in that VOO, you're looking at about a 13% year over year growth factor when you take the average. So they went back 15 years. The ETF of the VOO was right around, I believe, a 14% growth for the last 15 years on average. Now, of course, some years are going to be up, some years are going to be much higher down, but the average was around 14% growth for the ETF. Now, on the flip side of that, the high yield savings is where you're going to be banking and keeping that emergency fund. Now, some of the high yield savings, and I do have some links down below, I have all of my emergency fund in M1 Finance. They offer a high yield savings account, which returns 5%. That is about the industry average. Now, again, the difference between ETF is actually investing in a portfolio, investing in the market, where the savings account is keeping that money liquid. Now, again, when you're looking at your emergency fund, you want to keep those funds liquid, but what you're trying to accomplish with those funds is, one, that of course is going to be your emergency backup, but two, you want to get a rate that is going to try to hedge out inflation, because I don't want to put it into a basic savings account. Most financial institutions have about a 0.3% return, meaning with inflation being 3, 4, 5, 6%, you are losing money keeping your money sitting in that savings account, which is the reason why you got to have somewhere that it's at least going to grow something, and it's going to grow to try to hedge or try to at least keep up with inflation on that emergency fund. Now, of course, when it comes to investing, there's a lot of different things and a lot of different terms on this. And when it comes to investing, I really feel like long-term. For a lot of people, they'll put money into an investment account, or they'll buy some stocks, they'll buy some ETFs. All of a sudden, they'll see a variation in a couple of days. Let's say a stock goes down 3%, goes down 5%. They lost money, they cash it out, they are done with it. They're not investing it into it anymore. When you start getting into investing, it is roughly a 7+ year term. There are a lot shorter investments depending on exactly what you're looking for, but that is kind of the general rule that I look at. And again, looking at a multitude of years over ETFs, when you look at the market, even looking at individual stocks, if you want to pinpoint again some of the Apple, the NVIDIA, the Tesla stocks, you can look at them and seeing, in a short term, they might have had a loss. When you start getting a week or two, even a month or two out, there might be a short-term loss. But when you start looking at years, and again, looking at 2 years, 5 years, 10 years, 20 years, 30 years, when you start looking at years, there is not many things in the stock market that have lost money really to any magnitude, because the stock market continues to grow. We start investing more money, and of course, it's going to grow bigger and bigger. Now, one thing to remember when it comes to investing is, this is a question I get all the time: should I do traditional or should I do Roth? There is a very, very separate system between this. When you look at a traditional 401k, even looking at a traditional IRA, when you're putting money in there, you are getting a tax advantage the year that you put the money in there. That is something to remember, because when that grows, and again, when you have a timeline, let's say, 10, 20, 30 years, your money is going to exponentially grow within those traditional products, the regular traditional IRA, the traditional 401k. When it comes for time to redeem those, you pay tax on the entire account. So if I put 500,000 into a traditional, 30 years down the road, my 500,000 I put in is now $2 million. I pay tax on that $2 million. Now, granted, I did get a tax break when I put that $500,000 in, but I am now paying tax on $2 million. Now, theoretically or hypothetically, when you get to that point, you might be in a much lower tax bracket. But again, as the brackets continue to change, they adjust. We know even tonight, this year is an election year. We could see some changes in the tax brackets, which means you still have a big tax penalty that you're kicking down the road. And that is really the honest way that I see it, is you're taking a very short-term tax advantage that we have right now to essentially pay a lot more taxes down the road when you grow this account to a monumental stack of cash. A big chunk of that is going to be taken for taxes. Now, on the Roth side, the Roth IRAs and the Roth 401ks, which my company, luckily enough, does offer a Roth 401k, which I fully invest 15%. Roth, you pay the taxes today. So everything that's going in there is after tax dollars. So everything I'm putting in there, I have paid the tax. Now, again, if you think the same scenario, so I put in $500,000. When it grows in 30 years, I have my $2 million. That $2 million is tax-free. Taxes were already paid. I didn't get the tax advantage when I put the money in. Looking at my $2 million stack of cash, it is mine. It is 100% mine. It is all mine. I can take every penny of that. I don't have to take a certain amount out every single year. I don't get taxed on that certain amount. So the way that we actually broke it out, and again, it comes with a lot of education. It comes with a lot of planning, is I do put everything into a Roth 401k. My company match is a traditional. So the small percentage that they're matching is in a traditional. They don't match the Roth, but they match it as a traditional, as my employer contributions, which means there's going to be a big chunk that I possess, which is my 15% of my income, which is going to grow completely tax-free for me. The employer match section, which is going to be taxed later on, is the money that I plan to take out to supplement my income. Once I hit the age that I have to start taking money out of there, I can take money out of there. I'm going to pay my tax on the smaller amount that is in there, because all of that is coming from the company match. And it's not going to be money essentially that I got a tax benefit on when it was going in. Big thing here, again, when you look at mathematically, when you look at that 10, 20, 30 years, doing a Roth makes more sense because of the growth factor. That is the reason why we do a Roth with everything, including the 401ks, because beneficial when you get down years down the line, you are going to have that money completely tax-free. Now, how do credit cards calculate interest on debit? Do they charge interest every month on the total amount left on the debit? So very interesting, Kraken. So that question, I'm going to pop up here. So when it comes to the credit card companies, they do it differently. So the actual accumulation is on a monthly basis. So it is on the outstanding balance. So essentially the way that it's calculated is it is on the balance you carry forward. So let's say at the end of last month, which was February, you owed $5,000 on your card. The next one is going to have the interest, which is owed for the $5,000 that's on the card. Now, the interesting part of this is you can actually have two different rates with the majority of cards, and you can have two different accumulations on how your interest is calculated. So what I mean by that is most cards have one, a purchase APR, which is the annual percentage rate, and two, they will have a cash advance APR. So they will usually have two different APRs. So let's say, for instance, your purchase APR is 22%. The cash advance APR, which is usually higher, could be 30%. Now, the other thing that they do is when you have most of the cards is there will be a point where the purchase APR will be calculated on the monthly basis like we talked about. A lot of companies will calculate your cash advance APR on a daily basis. So again, The same card can be calculated two different ways, Kraken, which is pretty interesting. And then, of course, when you make your payment, a majority of institutions will put that payment towards the lowest interest rate. So again, if you have a section of your card that is 22% on a balance of, let's say, $4,000, you have a 30% balance on that last $1,000, which was the cash advance you did or was treated as a cash advance. Chances are when you make your payment, it is going towards the lower APR that is coming off of there, which leaves you stuck with the bigger amount of the cash advance. I know it seems pretty shady. The government was coming up with kind of a regulation or a rule that they were going to have to pay it back on the highest interest rate first, but a majority of them I don't think do at this point. Some cards have a flat fee and have a flat rate. For majority of cards, again, the average is 22 to 24% when it comes to credit cards, when it comes to your APR. Some institutions, like for instance, I said earlier, I work for a credit union. We have fixed rates cards. The purchases and the cash advances have the exact same rate. Some of them have balance transfer fees. Some of them do not. Our cards, unfortunately, do not have an annual fee, do not have a cash advance fee. But one of the big things with the fixed rate cards is a lot of them do not offer rewards. So when you start getting into the rewards programs, again, if you're not paying your card off in its entirety every single month, you are footing the bill for everybody else who is paying off their card with the rewards program. And it's super, super expensive. I cannot stress enough how credit card debt, high interest debt is literally crippling everyone in the nation that is carrying this debt because it is so astronomically expensive, especially when you get to the point of having $5,000, $7,000, $10,000 in credit card debt. There's a tipping point where as an individual, you only make so much income. As rates continue to go up, as the minimum payment requirements continue to go up, if you continue putting money on that credit card, your minimum payment is going to increase. And there is a tipping point where you can no longer afford to make that minimum payment, or the balance has got too high that it's really just kind of out of your hands. You're struggling to keep up. Now you start getting late payments, you start getting missed payments. And then of course your credit score is affected. All of a sudden your rates go up higher, or you're not going to get approved for debt consolidation. You're not going to get approved for an auto loan. You're not going to get approved for a mortgage because of the credit card debt. It is literally probably one of the biggest absolute pandemics that I have ever seen. Credit card debt is out of control. And for a majority of people, and the interesting caveat to this is at the beginning of this, we did talk about budgeting. Majority of people that I talk to, I would probably say 98% of individuals that I sit down, that I do budgeting, that I do financial counseling with, 98% of them do not have a budget, don't have a method. Even when I ask them the question, how much do you make every month? Don't know. It's a big question mark. What are you paying for with the money that you earn? Again, big question mark. I know my rent's XYZ. I know I pay this much on my car. My auto insurance is this. The rest of it, I have no clue. When you start breaking it down with the budgeting method, when you break it down mathematically, and I really do challenge you guys to do this. This was actually something I did when I did my master's program for my degree. We broke down mathematically in a finance class exactly how much we spent for 3 months. They made us bring in 3 months of bank statements, 3 months of credit card statements, 3 months of anything financially in your life that you could actually have. We put it all into Excel spreadsheets because it was old school. We broke it into different categories, knowing exactly where every dollar went. Now, again, this goes back to old school Dave Ramsey. You got $1. Where's the dollar going? What is the dollar going to be used for? And really, what is the value? For a lot of places, people don't know how much money they're making. They don't know where that money is going. And it is absolutely detrimental when it comes to the budgeting, even when it comes to the debt repayment, when it comes to things you want to do in life. If you want to retire, if you want to go on vacation, anything you want to do, you can build it into a budget. You might not even call it a budget. I know that the newer term for it is a spending plan, which they say don't track everything in the spending plan. Don't make it as tedious as it needs to be. But honestly, you have to know where your money is going. That is really the fundamentals where I feel like we've been failed and they have failed for so many years when it comes to formal education. Imagine if you learn this at a very young age. If there was a course in, let's say, middle school to high school that talked about budgeting, that talked about your credit score, that talked about debt, that, talked about entrepreneurship, talked about credit scores, saving, investing, it would literally be a game changer for the nation, the world, really, to understand finances. And also, a majority of people said that they don't have conversations with their family. They don't have conversations with their spouses, with their significant others. They don't have conversations with family. They don't have conversations with friends. Most people, when it comes to finances, it is such a taboo subject that nobody talks about it, which I don't understand. And one of the big driving factors why we built this channel is the financial education piece that they're missing in such of the education system, or even, again, having that conversation with people that are in your life. Most people don't talk to their spouse. It is the person that you chose as a spouse or as a significant other. It is the person that you chose for the rest of your life that you're spending your time and effort with. And out of everyone, you can't choose your family, can't choose your siblings. You can choose your spouse, and you did choose your spouse or your significant other, whoever it is. Make sure you're having the conversation about money with them on a regular basis. We sit down once a week. We have conversations. My kids are included. And with that, it really seems like they've built and established a baseline of a sense of savings. We have CDs for them. We have MESP programs, which are college savings accounts, but they also know the value of money. And that is what I'm really trying to instill in them, is when it comes to, $4.99 for this, $7.99 for that, it costs $9.99 for Netflix. They know the value. They know what the cost of that is. And even things where we'll go shopping, she'll look at it, my daughter, and they'll say, that's too expensive, or that's cheaper here. They're almost bargain shopping at the age of 10, which is incredible. But knowing the value of money and knowing the value of actual money, not the plastic everyone keeps in their pocket that they pay for everything, but knowing what is in your account. What does it look like if you're paying cash? What does it look like, when you're using your debit card? For my kids, we go shopping, we collect Pokemon cards and Magic the Gathering cards. I give them an allotted budget. They cannot go above that budget. And a lot of times I give that to them in cash. That way, if it is above and beyond what they have, they're putting things back, and they know that. We've established a ground rule, which is really cool. But again, kind of getting a little bit off on a rant right there. But again, the education piece is what we're really missing. So very cool to do the live stream, guys. I love doing these live streams. I want to try to do them at least once a week. And thank you for Isaiah's, I think that's how I say it, and Kraken for joining us here. We're going to continue to grow this channel. We're already over 6,000 subscribers. So if you guys haven't subscribed, go ahead and subscribe. We're going to be doing this again every single week with a live stream. And I love kind of how it's set up here in StreamYard. This is the second time ever actually doing the stream through StreamYard. So it is really cool to see how the setup, and we can actually have other guests, invite people in. There's going to be a lot of stuff that is going to be coming. Very, very cool. But guys, that's going to do it for today's live stream. Definitely let me know in the comments if there's anything we need to add, remove, kind of topics that you want to see as well. Definitely drop them down in the comments so we know. And as always, thank you guys for watching.